Okay. Good evening. Okay. This we have discussed, right? Is this clear? Yes. Value of final output minus intermediate consumption. This is what you have written, isn't it? Okay. And this value of output can be divided as sales. Okay. See, value of output, generally value of output here for us basically we are not, since there are no numericals, we need not remember all this, but just for understanding, you have understood this, it is sufficient. Okay, we understood this, it is sufficient for UPSC. Okay, so value of output minus intermediate consumption. Why did we subtract intermediate consumption? So to avoid what? Double counting. Okay. Now so value of output can be sales. Sales, one is sales. Okay. And one can be unsold stock. One is sales, sold. Another one is unsold stock. Unsold stock, or use the word inventory. Okay. So we'll come to this discussion now. See here, more than this understanding, the next understanding is important. So first is we have understood in the production method or the output method, we have understood the concept of GVA. And remember that GVA concept is not new. It's a earlier concept itself. It's a method for calculating national income using product or production. Okay, so that is not new concept. It's not a new concept. Okay. So, but what they did in the recent past is they have come up with a concept called as basic prices. Okay. So, in the recent past, that is in 2015, the new change that they have brought in is coming up with calculating GVA at basic prices. Okay. So, what is this basic price? We'll try to understand and then we'll move forward. See here, we all know about factor cost. Yes, okay, and we have also understood about market prices. Okay, and you remember we have written a formula. Market price is equal to factor cost plus net indirect taxes. So in 2015, when they have come up with new calculation, okay, one of the important aspect they have come up is calculating the output at market anyhow they'll do. They are calculating it at basic prices instead of factor cost. So directly they will come to basic price, and from basic price they are going to come to market prices. This is what they were doing. Okay, so what is factor cost? What is the meaning of factor cost? Cost of factors of production. Cost of factors of production, or it is nothing but Viper, isn't it? It is nothing but Viper, or it is nothing but, I can write it in the government documents, this is how they are writing. Okay, or it is Viper, or it can be this. This is what is the factor cost? Cost of factors of production, compensation to employees, mixed income, operating surplus. Okay. Then they said in this basic prices, it is something like they have splitted this aspect of indirect taxes and subsidies. Splitting. There is a splitting that they have done. What is this splitting? See here, we can write this as what? Factor cost plus indirect taxes minus subsidy. This is what we can. Okay. Now this aspect has been split into two. What is the splitting they did? So they said indirect taxes can be divided into two. Okay, one is the production taxes. Okay, another one is the product taxes. Okay, another one is production subsidy. And two, we have product subsidy. Splitting has been done. So one is production taxes, taxes, product taxes, production subsidy and product subsidy. So for calculating basic prices, they are only going to take production taxes and production subsidy. They are only going to take production taxes and production subsidy. That means basic price will be equal to factor cost, that is this one, plus production taxes minus production subsidy. What they have not taken? What they have not taken is product taxes and product subsidy. So in the basic price concept, they are adding on. It can also be written as factor cost plus net production taxes. Is this clear? So net production tax is what? Production tax minus production subsidy. Okay. So market price has what? Market price has both production taxes, product taxes, production subsidy and product subsidy. Market price has both. Basic price has only production tax and production subsidy, and it does not have what? Product taxes and product subsidy. Now the question comes up, what is a production tax? Since we have discussed in WTO discussion, agreement on agriculture, we have discussed something like product subsidy and production subsidies, if you remember. So what was the discussion we had? What is a production subsidy and product subsidy? Anybody? Time of producing the good? Very complicated. Your definition is very complicated. I have not understood. So, what is production subsidy? Inputs. Okay. Which one will be more trade distorting? Production subsidy or product subsidy? Huh? Don't worry, you can answer. Okay. MSP is product subsidy or production subsidy? Product subsidy. MSP. It is basically now that means everything has evaporated. Okay, so this is the understanding. The moral of the story is nothing is there in your head. That's clear. Okay, so production subsidy helps in indirect enhancement. Why? So I don't like so much of English. Okay, so okay. Production taxes Production taxes are those taxes, whenever we talk about production taxes are those taxes which are independent of production volume. Production taxes are those taxes which are independent of production volume. Independent of production volume. For example, Ratan Tata is manufacturing nano cars in a particular land. In this area, Ratan Tata is manufacturing nano cars. Okay. Now, Ratan Tata pays some tax on the land or the land revenue. The tax on this land or land revenue is independent of the number of cars Ratan Tata is manufacturing. He may manufacture 100, he may manufacture 1000. But the tax on the land revenue is independent of the number of cars produced. Are you able to get this? Independent. Okay, so this is called as what? Production tax. Production taxes are independent. I'm repeating, production taxes are independent of production volume. Okay. Taxes on land revenues or stamp duties, document stamp duties. So they are not linked to something like what you produce, how much you produce. Independent of that, you are paying the tax. That is called as production tax. But for suppose excise duty is there. Excise duty is paid on one car you are manufacturing, there is X amount of excise duty. 10 cars you are manufacturing, then excise duty is going to increase. On each product you are producing, there is excise. Are you able to get this? Each product you are producing, there is excise. That means more the goods you produce, more is the tax. This is called as product tax. Excise is basically a product tax. So excise duties or GSTs are not there when I am talking about production taxes. Are you able to get this? So production taxes are those taxes which are independent of production volume. So whatever you are producing, how much ever you produce, that will not affect the tax which you are paying. Such a kind of tax is called as production tax. I hope it is clear. Is that okay? Yes. Then similarly, production subsidy. So production subsidies are those subsidies which are again independent of production volume. For example, government is giving fixed subsidy. Fixed amount of subsidies it can give to farmers. Fixed subsidy. It can give to farmers, or it can give fixed subsidies to cooperatives. Cooperative. X amount means X amount only. So to cooperatives, like government decided to milk cooperatives, we will give some X amount of subsidy. Or for textiles, we are going to give fixed amount of subsidy. Okay, these are fixed. Or government decided to give subsidies, fixed amount of subsidies to railways. Fixed. Now these are what subsidies? These are production subsidy. Production subsidies, because they are not linked to the production volume. They are not linked to the production volume. Is this clear? Okay. So when I use the word production tax or production subsidies, these are independent of production volume. Irrespective of how much you produce, the value always remains the same. So the tax value remains the same. Is this clear? Okay, so here what we have written, basic price is equal to factor cost plus net production taxes. Net production tax means production tax minus production subsidy. This is what we have written. Then what they do is they calculate GVA at basic prices for all the sectors. For all the sectors. That means they calculate it for primary, they calculate it for secondary, they calculate it for tertiary. You calculating the sector specific data you are going to collect for basic price data for all the sectors. And then you will try to arrive at GDP at market prices. So this GDP at market price now will be equal to GVA at basic prices, GVA at basic price plus, now you are adding what? Net product taxes. net product taxes. Is this clear? Net product taxes. Net product tax means product tax minus product subsidy. Product tax minus product tax minus product subsidy. Is this clear? Okay, so what is not there in basic price is net product taxes, like GST, like excise, like customs. Okay, that is not there in the basic price. Is this clear till here? Okay. So how do they calculate, now how do they calculate national income? They have to calculate national income using product method. Okay, using product method. So first is what they do. You arrive at GVA at factor cost. GVA at factor cost. We did know for the miller, baker. Okay, GVA at factor cost. We have arrived at 2000 rupees, isn't it? Okay, so now this can be also, if I have production, this can also be written as that value GVA. Okay, so or if it is nothing but something like equal to the cost of factors of production. Somebody's production is equal to somebody's income. You're producing something and it is getting converted into income, and that income is getting converted into expenditure. And that is the reason we are writing it as CE plus MI plus OS. I can write it this way. Okay, and from here they will go to GVA at basic price. Okay, so this is something like this aspect, that is GVA at factor cost plus what? Net net production taxes. This is how we arrive at it. Okay, and then from here, okay, you will try to find out GVA for every sector. You do sigma for every sector. Okay, so then GDP at market price you will come to. Okay, this is basically you are doing basic price plus, now here this is production, so you may get confused. Wait, so this should be what? Product. Okay, so this should be net product taxes. Okay, from here again it is simple. They go ahead with NDP at market price, or NDP at, suppose I have to go to NDP at market price, then what should I do? I have to remove what? Gross versus net means what? I have to remove depreciation. This is first thing. Okay, and then from here you do NDP at factor cost. So how do I get there? What should I do? Net product tax minus depreciation. Okay, so what should be removed? Factor cost, market price, net indirect taxes. Net indirect tax. Is this clear? Okay, and then to that you add again what? Net factor income from abroad. This is how they step by step they go. First is you arrive at GDP at market price, and from there you go to the other aspects as we have done. Okay, so here only confusion you may get is what is this basic price? Other things actually we have discussed is the same thing. What is basic price? Is this clear? CE plus MI plus OS, that is nothing but factor cost. Nothing but factor cost. Okay, we'll first keep writing, we'll understand. Put the heading production method. Production methods. It has two approaches. One, final product approach. to value added approach. Value added approach. Then put the heading final product approach. Final product approach. Okay, now see here, expenditure method is there and production method is there. Out of these two, which one is estimating national income from the supply side? I'll repeat the question. Expenditure method is there, production method is there. Two methods are there. Out of these two, which one is calculating GDP or which one is calculating national income from the supply side? Production side. Understood? No. Production side is calculating GDP or estimating GDP from the supply side. Isn't it? Production, output, supply. Okay. Expenditure method is calculating GDP from the demand side. Demand from the households, demand from the private player, demand from the government, demand from the rest of the world. Isn't it? So, expenditure method is calculating it from the demand side. Production method is calculating it from the supply side. Is this clear? Okay. Fine, fine. Write down. Final product approach. Write down. Final product approach. First point. This approach calculates national income. This approach calculates national income from the output side. From the output side. That is, we measure the value of all that. We measure the value of all that is produced. Measure the value of all that is produced in the domestic economy. All that is produced in the domestic economy. So, final product method, how do I calculate the GDP? See here, basics class. Final product is something like this. Okay. So, what did I do? Remember, we have used quantity into price, GDP calculation. Remember that? So, this is same only. This is the current prices, current price or the market price, market price. This is quantity of goods, quantity of goods. And this is again price, and this is quantity of what? Services. You arrive at the value. This is the final method. Okay, so final output, not the GVA method. Is that clear? Okay, you are doing quantity into price for goods plus quantity into price for services, both. Okay, so write down next point. It is estimated by multiplying the gross product, multiplying the gross product with market prices, to arrive at GDP at market price. To arrive at GDP at market prices. Okay, then write GDP at market price is equal to P into Q plus P into S. Is that okay? Yes. So P is the market price. P is the market price. Q is the quantity of goods. Q is the quantity of goods. S is the quantity of services. S, quantity of services. Okay. Next, put the heading value added approach. Value added approach. It measures the contribution of the contribution of each producing unit in the domestic economy, each producing unit in the domestic economy each producing unit in the domestic economy, avoiding any possibility of double counting. Any possibility of double counting. Next point. Net value added at factor cost is equal to net value added, not GVA, I'm making it NVA. Net value added at factor cost is equal to gross output minus intermediate consumption minus depreciation. We have written net value added. That is the reason we have subtracted depreciation. Is that clear? Okay. Next, put the heading steps involved in calculation. Steps involved in calculation. First point, identify all the producing units. Identify all the producing units. Identify all the producing units in the domestic economy. In the domestic economy. And classify them into three sectors. Three sectors such as primary, secondary and tertiary. Primary, secondary and tertiary. Primary sector produces goods. Primary sector produces goods by exploiting natural resources. By exploiting natural resources. Like fishing, mining, etc. Like fishing, mining, etc. Is that okay? Continue. The secondary sector produces manufactured goods. The secondary sector produces manufactured goods by transforming one type of commodity into another type of commodity. Like construction or electricity generation. The tertiary sector renders services. Like education, renders services like education, comma, medical, comma, banking, etc. Is that okay? Next point. Estimate net value added at factor cost. Next point. Estimate net value added at factor cost by each producing unit, by deducting intermediate consumption, comma, depreciation, and net indirect taxes, from the value of output. From the value of output. Okay, third point, write down. Estimate the net value added. Estimate the net value added of each sector in bracket primary, comma, secondary, comma, tertiary. Primary, comma, secondary, comma, tertiary. Close the bracket. By summing up the net value added, at factor cost of all producing units in each sector. Is that clear? Okay, next point. Compute domestic income. In bracket NDP at factor cost. Close the bracket. NDP at factor cost. Close the bracket. By adding up the NVA at factor cost. Of all the three sectors. Is that clear? Then next point. Estimate net factor income from abroad. Which is added to domestic income. For deriving NNP at factor cost. Is this clear? Okay, so that means you are calculating NVA at factor cost for each sector, primary, secondary, tertiary. You are adding all that up, then you arrive at NDP at factor cost. Okay, and for that NDP at factor cost, you are adding what? NFIA to arrive at NNP at factor cost. This is how the calculation happens. Of course, what are the different methods? UPSC asked once in mains, what are the different methods used for estimating GDP long back? Okay, then you have to write expenditure method, product method, and now they'll not ask. Because already they've asked and you know now. If they ask also, you can write. So next, put the heading precautions. There is some problem with precautions. Just write down items included / excluded. Okay, under that, first put the heading items included. There may be some doubt with these, that is why we have to mention them. They are important for prelims. Items included. First one, write down. It includes imputed rent of owner occupied houses. It includes imputed, IMPUTED. It includes imputed rent of owner occupied houses. That means in national income calculation, there is self-occupied house. That means imputed means this is something like if you are the owner of a house, if you wouldn't have been the owner of the house, if somebody else has to take it for rent, whatever rent he is going to be paying will be included in the calculation. Are you able to get this? Imputed means this is your house. You have occupied your house. Okay. And if you wouldn't have occupied, or if this house is not there, you would have occupied something else. Okay, so you are trying to impute the rent. If it wouldn't have been your house, then what is the rent that has to be paid? That is also included in the calculation. So imputed rent of owner occupied houses. Imputed rent of owner occupied houses means this house is occupied by owner. That means logically there is no aspect of rent which is visible. But still you are imputing the value of rent and you are adding it in the calculation of national income. Are you able to get this? Imputed rent of owner occupied houses is also difficult to calculate. It is difficult to calculate, but it is also included in the calculation of national income. So whenever we are saying C plus MI plus OS, or whenever I am using the word rent, now you are also including the rent, imputed rent of owner occupied houses. Imputed rent of owner occupied houses. That means though it is occupied by owner, physically there is no aspect of a transaction which is visible. You are imputing the value of rent. Imputing the value of rent means if it wouldn't have been your own house, if you would have given it for rent, whatever amount you would have got, okay, that is included in the calculation. This is the meaning of imputed rent of owner occupied house. Is this clear? Okay, second point, write down 2. Value of own account production. Value of own account production. Own account production by enterprises. By enterprises, government and households. Government and households. That means if somebody is producing something for his own account for their consumption, they are producing it for their using it, that production is also going to be included in the calculation. Are you able to get this? He is not buying it from outside. You are producing it for your own entity, your own consumption, whether it is an enterprise, etc. That production is also included in the calculation. Is this clear? Understood? So own production for you, that is also included. Imputed rent of owner occupied houses is also included. Clear? Next point, write down. Only value added and not value of output by production. And not value of output by production. Not value of output by production units should be included. Should be included to avoid double counting. To avoid double counting. This is clear. In that farm, the miller, baker, you are not including the output, but you are only including the value addition. 1000 minus 500 we are doing. No, you are only including the value addition, not including the output, because it will lead to double counting. That is what we did. No, see, we have subtracted. No, value of output was something intermediate consumption. Okay, so then we have subtracted both, and the remaining value started adding, isn't it? Okay, so not the final value of output you have added, but rather you have only adding the value addition. This is nothing but the value addition. Is this clear? Yes. Do not include the sale of, do not include the sale of second hand goods. Do not include the sale of second hand goods as they are not fresh production activities. As they are not fresh production activities. However, brokerage or commission paid brokerage or commission paid to facilitate the sale is included as it is a fresh production activity. As it is a fresh production activity. Is that okay? Yes. Clear? Next one, items excluded. Put the heading items excluded. Sale and purchase of second hand goods. Sale and purchase of second hand goods. Sale and purchase of second hand goods. Okay, not included. 2. Sale of bonds by a company. Sale of bonds by a company. This is merely a financial transaction. Write down. This is merely a financial transaction. Which does not contribute directly to the flow of goods and services. To the flow of goods and services. Is this clear? And we have written yesterday smuggling, gambling, which is all not accounted for. That is also not included. That should be, you know this. Is that clear? Okay. See, second hand, somebody was asking the other day, sir, I purchased a car 5 days back, let's say, and I'm selling it back again. Now, will that get included? No, you purchased it for 5 lakhs, already it got included. Okay, now you are again selling it for 4.5 lakh, that will not get included because it is a second hand sale. Is that clear? Yes. Next, put the heading GVA at basic price. GVA at basic price. First point, in 2015, it was decided by CSO. It was decided by CSO that a sector-wise estimate of GVA at basic prices, will be released instead of factor cost. Okay, next point. The concept of GVA at basic price, is different from factor cost, or market prices. Okay, then write the formula. GVA at basic price is equal to GVA at factor cost, GVA at factor cost plus net production taxes, plus net production taxes. Is that okay? Net production taxes. Below that, write net production taxes is equal to production taxes minus production subsidy. Production taxes minus production subsidy. Next, write down production taxes and production subsidies. Production taxes and production subsidies are independent of volume of production. Are independent of volume of production. Clear, no? Whereas product taxes and product subsidies are paid or received based on per unit of the product. Example of production taxes include taxes on land revenue, stamp and registration, etc. Production subsidies include subsidies to railways, fixed input subsidies to farmers, and a fixed amount of subsidies to cooperatives. Next point, while product taxes include taxes like GST, customs, etc. Product subsidies include food subsidies, fertilizer subsidies, etc. Okay. Then write the formula. GDP at market prices is equal to GVA at basic price plus net product taxes. Is this clear? Okay. So let's discuss the expenditure method, which expenditure method to some extent you already know. So this is basically expenditure method can be seen as the demand side. Expenditure method is seen as the demand side. Okay. So GDP at market price, remember, is equal to, we've written C plus I plus G plus X. Okay. So this is something like the household consumption. This is mainly investment by the private sector. It can also be investment by other sectors also, but it is mainly investment by the private sector. Okay, when I talk about investment, investment can include gross fixed capital formation. I'm writing something here, gross fixed capital formation. So earlier we have discussed one, I gave you one mains question if you remember. Savings is an important factor for capital formation. What are the other things other than savings which can affect the capital formation? Is that clear? Okay, so capital formation is nothing but accumulation of capital goods, machines, all this, isn't it? Okay, so here in the investment part, one is GFCF. GFCF is what? Gross fixed capital formation. When I'm saying gross fixed capital formation, it is investment into physical assets. Physical assets can be plant and machinery, physical assets. Okay, or it can be infrastructure, etc. Physical assets like infrastructure, etc. All this is what gross fixed capital formation. Gross fixed capital formation. That means investment into machineries, capital goods, infrastructure, all this comes into GFCF. Is that clear? Okay, and then it can also include something called as inventory. It can also include inventory investment. It can also include inventory investment. When I use the word inventory, inventory is nothing but the semi-finished goods, the inputs which the company holds. Inventory is always used for what? Future production. Inventory is always used for what? Future production. Are you able to get this? Inventory. See, inventory is also seen as investment. So in the basic class, we have discussed the basic definition of investment. We said investment is something that leads to future output. Yes or no? Okay, so investment is something that leads to future output. So one is investment into physical assets like plant and machinery, infrastructure, all this. Another one is the inventory of the company. Inventory is nothing but the raw materials, semi-finished goods, all this which is there as stock with the company, which will lead to what? Future production. So this inventory can also be mentioned as something like change in stock. Inventory can also be mentioned as change in stock of the company. Okay. Yes. Inventory is change in stock. So change in stock is nothing but the closing stock minus the opening stock of the company. Okay, is that clear? Closing stock minus opening stock. So here, okay, so inventory is something like the raw materials, semi-finished goods which the company is holding and which will lead to the future output. So inventory investment is also part of I. Is this clear, everybody? One is the gross fixed. Major chunk is the gross fixed capital formation. This gross fixed capital formation is into machines, capital goods, infrastructure, all that will be part of I. Then G is what? Government spending. And X is nothing but the what? Exports. Okay, so here, see, the opening of the account here, okay, so that is the stock was something like 1 lakh. Okay, there are 10 sets, let's say there are 10 shirts which is there. Okay, now the closing stock, basically there's more procurement which the company thought. When will company procure more? When the company will procure more is when it expects that there is going to be more sales. So at times you are not estimating properly, then obviously you have procured more, probably you will have something like more at the end of the year. Are you able to get this? At the end of the year, you decided to have, you had 10 shirts at the beginning of the accounting year, you decided to sell it, process it and sell it, okay, but you decided to procure more in between, you decided to bring in another 20, okay, but sales were only 5, 10 were already there, you procured 20, that means total how much? 30, and you have sold how much? 5. So your net inventory is 30 minus 5. So how much is left? 25. Are you able to get this? Is that clear? So this, is this clear? 25 is there in the stock. Now this is nothing but the what? Inventory. This is also part of what? I or investment. Till now UPSC has not asked. Till now, till date, there was not even a single question. They have only asked this formula. This formula they have asked. Till now there was a formula which they have asked. That formula is something like x minus m and all. That was the only question they have asked. They did not ask what are the components of inventory. Or till now they have not asked whether change in stock is investment or not. Such a kind of question also was not asked till date. But there is every probability, seeing the question paper recently, they may ask which of the following will constitute investment in our expenditure method of calculation. So one is fixed investments into buildings, etc. Yes, you're investing into buildings, etc. That is part of the construction. 2, infrastructure. Yes. Machines, etc. Investments into machines, capital goods, etc. Yes. Then inventory or change in stock. All the 4 which I have mentioned are part of what? Investment. If at all he is going to ask, and there is every probability is increasing the level, no? Is increasing the level. So remember, change in stock is also part of investment. So what is change in stock? Closing stock minus the opening stock. Okay. So in that example of shirts, the change in stock is 25. 25. Okay. So then going by the basic definition of GDP, GDP is nothing but the total final value of all goods and services produced in the domestic territory. That means I don't want imported consumption. That means if the households are buying some imported goods, I'm not interested in those imported goods. I'm going to deduct. Similarly, if the private player is importing some machinery from outside, that also I'm going to deduct. Similarly, government is buying some imported raw material or goods or something, not raw material, goods or something, that also I'm deducting it. Plus what? X. X is what? Export. So therefore, this can also be written as C plus I plus G minus, I can write it as CI, this is imported consumption goods, imported investment goods plus imported garment goods. I've added all, okay, plus I have written X. X is what? Export, okay. Now this CI plus II plus GI is nothing but the total import. Total import. This is a total import, no? So this import I am writing it as M. M is nothing but import. So now the formula becomes C plus I plus G plus X, this is the export, minus M. So this again I can write it as C plus I plus G plus NX. NX is nothing but the net exports. NX is nothing but net exports. Is this clear? Okay, so this we have already, I think we have similar kind, we have done it in the investment model class. So net exports. Now if a foreigner is coming and buying some goods in India, okay, so where will it get added here? Foreigner or a tourist, somebody has come to India, is buying some goods in India. So where will it go? Investment. Oh. I thought you will say something other than how foreigner is coming, a tourist is coming, is buying some shirts or whatever it is, then how can that be investment? Is he using that shirts to produce some other? It is part of export. It is part of export. You're selling, you're exporting something to others, you get what? Dollars. You're selling that shirt to somebody in the foreign country, you receive what? Dollars. Similarly, instead of you selling it, that fellow has come and purchased it. Okay, so that is also nothing but what? Export. It is part of export. 2014 UPSC question. No. See, when he's coming to India, it is basically, when he's coming to India, it is somebody who's buying from outside. It is treated as somebody who is out from outside who is doing the transaction. You may say he is also converting dollar into rupees, but because of that, dollar got converted into rupees, as simple as that. And okay, so that is the reason we take it as export. Is this clear? Okay, so put the heading expenditure method. It measures the final expenditure. It measures the final expenditure on GDP at market prices, on GDP at market prices during a period of time. During a period of time. Next point. Since all domestically produced goods and services are purchased for final use, either by consumers for consumption or by producers for investment, Therefore, we take sum of final expenditure on consumption and investment to arrive at GDP at market prices. See, why consumption plus investment? This is, C is consumption of household, G is consumption of government, X is consumption of the foreign entity. Okay, and then you have investment. So you are taking consumption plus investment together and you are adding it and you are arriving at what? GDP at market prices. That is why you may think, well, sir has not mentioned government, sir has not mentioned X. So ultimately G is nothing but government's consumption, X is nothing but consumption of the rest of the world, okay, and C is the consumption of the household, and therefore we have written consumption plus investment. I hope it is clear. Okay, so then write down next point. The final expenditure is the expenditure made on the purchase of domestically produced goods and services for final use. Continue, full stop and continue. By deducting depreciation and net indirect taxes from GDP at market price, from GDP at market price, and adding it to NFIA, we arrive at NNP at factor cost. NNP at factor cost. Okay. Next, put the heading steps involved in the calculation. Steps involved in the calculation. First one, identification of economic units. Identification of economic units. Incurring final expenditure. Incurring final expenditure. Incurring final expenditure. Example, household or consuming sector. Comma, firm or producing sector. Firm or producing sector. And government sector. Okay. Next point 2. Classifying the final aggregate expenditure. Classifying the final aggregate expenditure into the following components. Into the following components. First one, private final consumption expenditure. Private final consumption expenditure. Private final consumption expenditure. Okay. 2. Government final consumption expenditure. Government final consumption expenditure. 3. Gross fixed capital formation. Gross fixed capital formation. 4. Change in stock. Change in stock or inventory investment. Or inventory investment. Change in stock or inventory investment. Okay. Next, net exports. Net exports. Net exports. Is that okay? Clear till there? Next, put the heading. So if you add all this, you arrive at GDP at market price. That is what? GDP at market price is basically when you are adding all this C plus I plus G plus that net export, you are arriving at that GDP at market price. We'll come to that. Then put a small note about gross fixed capital. Gross fixed capital. It indicates expenses incurred. It indicates expenses incurred during purchase of fixed assets. During purchase of fixed assets. Gross fixed capital can be further categorized. Gross fixed capital can be further categorized into two types. Into two types. One, Gross business fixed investments. Gross business fixed investment. Gross business fixed investments. Write down. It includes expenses. Investments towards long-term assets. Towards long-term assets. Such as machinery, production facility, comma, infrastructure, etc. Is that okay? Then 2, gross residential construction investments. Gross residential construction investments. These are expenses incurred by businesses. These are expenses incurred by businesses for constructing residential units. For constructing residential units upon receiving tenders. Upon receiving tenders. Upon receiving tenders. So that is building some residential property, etc. That is also going to be part of gross fixed capital formation. Is that clear? Machinery or infrastructure or plant, that is production facility, or it also includes, suppose the business house is coming up with building some residential properties, etc. That will also be part of gross fixed capital formation. Okay. Then 2, investment, next, that is over. 2 you have written, no? The next point, write down, next point. Investment also includes inventory investment. Investment also includes inventory investment. Inventory investment. These are investments made towards, investments made towards the acquisition of raw materials, comma, semi-finished or finished goods, semi-finished or finished goods, full stop. These are considered as items. These are considered as items that cannot be utilized for current consumption. Cannot be utilized for current consumption. Inventory investment is determined by calculating the closing stock balance and the opening stock balance, calculating the closing stock balance and opening stock balance at the end of each year. At the end of each year. Okay, in bracket write closing stock minus opening stock and close the bracket. Closing stock minus opening stock. Okay, next put the heading precautions. Precautions. To avoid double counting, expenditure on all intermediate goods and services, expenditure on all intermediate goods and services is excluded. For example, purchase of vegetables by a restaurant, should be included or not included? Not included. Comma, expenses on electricity by a factory, expenses on electricity by a factory, etc. are not included. Expenses on electricity by a factory, etc. are not included. Okay, next point, 2. What happens? आराम से. नहीं यार, तुम स्पीड बढ़ाना पड़ेगा. See, we are lagging behind by 1 class. अरे sir नहीं. बाद में we can discuss more mains questions. I have some plan, no? This is something you know already, and when you're writing, if you can increase your speed, don't write with 3 pens. Don't write with 3 pens and 2 pens and okay. Ready to get distracted. You're waiting for distraction. Right. Right on second point. Government expenditure on all transfer payments. Government expenditure on all transfer payments. Such as scholarships, comma, unemployment allowances, etc. Sorry, unemployment allowances, comma, old age pensions, right on. Old age pensions, etc. is excluded. Because no productive service is rendered by recipients in exchange. Is that okay? So tomorrow he will give government spending on unemployment allowance. Is it part of G? No, because it's a transfer payment. Are you able to get this? Is that clear? Okay. Next point, write down. Expenditure on purchase of, write fast. Expenditure on purchase of shares, comma, bonds, etc. Somebody was asking new share, old share, any share. Remember, new, old, whatever it is, not included. Is that clear? Okay, so IPO is also not included. IPO, yes. So expenditure on purchase of shares, comma, bonds, etc. is excluded because it is not payment for goods or services, which are currently produced. Is currently produced. I was thinking about the doubt. Said somebody has written, sir, you told before attending class economy is too easy. Now after attending class it seems to be complex. See, it is easy, but one or two chapters also you want everything in English only. See, one or two chapters will write some 3-4 formulae. That doesn't mean it is difficult. Anything is difficult that will not come in exam. As simple as that. You feel the formula is very complicated, like GV at basic price. He will not ask. Till now he has not asked. UPSC is very kind. Except for the recent exam, he was very kind. And why he has changed also, I don't know. Suddenly. But otherwise, UPSC never asked any complicated question in economics till now. Now also, even in the recent paper, now everybody is saying elimination is eliminated. Okay. But logically speaking, even there are 6 to 7 questions where some amount of logic, elimination may be eliminated, but logic will work. Remember this. Now somebody is asking, what is the mantra to clear the prelims? There is no mantra. It is only if you solve previous questions. Listen to this. If you solve previous questions sitting alone or maybe a group 3 to 4 times, you will evolve your strategy. This is the reality actually which nobody knows. Previous questions we solved many times. No. You would have solved it, but without applying your brain, you will solve. Without applying your brain, C is the answer. No. Pad liya na? Chalo nikalo. Next. You will not analyze. You will not even check the other 3 options. You have to Google the other 3 options. When you are reading previous questions, first 2 options, 3 options, you know the answer. Then what about the other 3 options? Who's going to Google it out? The other 3 options have to be Googled out and notes has to be prepared from old questions. Now if you do this, there is 100% guarantee, 100% guarantee, no 99, that GS 1 we can clear. 1, 2 we don't know. 2 is like our CAT paper. Okay, so when I was reading this time's CSAT, then I have understood, it reminded me of 2006, 7 when I wrote CAT. That time I have understood, oh, that means UPSC is also becoming cat and dog. Okay, so it is especially the questioning pattern. But there also there will be easy questions. If you solve easy questions, we will clear. Now somebody said it is becoming too complicated. Maybe 2-3 areas may be complicated. For example, basic prices or something where there is some complication. But I don't think there is some problem here. It will take some time. No, if we have done national income today. Maybe for example, we have discussed production subsidy, and after maybe 1 month or so or 15 days, when I ask you what is production subsidy, not even a single student has answered. That means production subsidy is already disappeared. I think you're getting it now. So if that is the case, there will be 3 or 4 areas, for example, nominal effective exchange rate, REER, or maybe 2-3 areas will be there where there is some complexity. But otherwise the whole is not like that. Okay, so somebody like Arya. So don't worry. Remove tension. What was the expenditure on purchase of sales and bonds is excluded because, write down, finish, that point is over. Okay. Okay. Same point, it shows the transfer of property. It shows the transfer of property from one person to another. From one person to another. Next point. Similarly, gifts from abroad, gifts will be included, not included? Not included. Similarly, gifts from abroad are also not included. Are also not included. I think it is clear. Understood. Wait. So, in national income, do we have transfer payments, national income calculation or GDP calculation? In GDP calculation, do we have transfer payments? No. What about windfall gains? Windfall gains? No. Windfall gains like lottery, betting, gambling is not going to be part of the calculation. We have discussed investment into shares, investment into bonds. Is it going to be part? No. Sale of second-hand goods? No. Sale of commission received on brokerage or commission received on the sale of second-hand good will be part of GDP calculation. As simple as that. Okay, so there can be a question in these areas which are included, which are not included. Simple understanding. You should understand why they are not included. Then only the logic works. For example, bonds are not included. Why bonds are not included? Because there is no movement of current goods or services when you are talking about bonds, or maybe shares. Company is raising money, but when it is going to use also nobody knows. Are you able to get this? So it is not about the current transaction which is happening. Second is you are selling your shares to somebody. That means these shares are moving from one fellow to another fellow, that's all. There is no creation of new things there. It is only movement of the asset from one entity to another entity. And that is the reason shares or bonds are not included in the calculation of national income. Another thing is imputed rent of owner-occupied houses. Okay, this is included. We have written there. Okay, and similarly, we have also written you are producing for your own consumption, production. They are producing for their own consumption. That is also included in the calculation. There is a difficulty in calculation. You ask, how do they calculate? It's a difficulty in calculation, but yes, they try to account it. They try to account it. So this is going to be part of the calculation. This should be clear. Okay, so when we talk about the concept of personal income, now listen very carefully. This is the next aspect, personal income. So what is this personal income? This personal income is the income for the households, income that is coming to the households. Okay, so income that comes to the household can be through both productive sources, productive. Okay, it can also be through non-productive. Non-productive. Non-productive is transfer payments. Are you able to get this? Okay, so this transfer payment is not part of national income. This transfer payment is not part of national income. Why? Because it is not a productive activity. It is not getting generated from the factors of production. As simple as that. For example, now if you could recollect that there is one firm, okay, and there is one household. Remember? Then we said the factor services are provided by this household, for which there is this factor payments. And this factor payment we have written in different ways. We have written it as Viper, we have written it as CE plus and all that. Okay, so whatever it is factor payment. Factor payment is productive payment. So this rent or wage or interest, it is getting into the household. It is becoming the income of the household. But this household, this is part of the national income calculation through production. Production is there, income method is there, expenditure method is there. This is what we did. Okay, this is part of, that means transfer payment. Transfer payment is not reflected here because transfer payment is not coming from any productive activity for which goods or services are exchanged. There is no production happening. But this household may receive some transfer payments from outside. Now this is going to be part of his personal income because he will use that money for buying something outside. Suppose government is giving old age pension. 4,000 rupees every month. Now with this 4,000 rupees, he will go out and consume rice or consume wheat, whatever it is. So that means these transfer payments are part of his personal income. So this is also part of his personal income, as well as something that is coming in the form of transfer payment is also part of his personal income. That means transfer payment, though it is not part of the national income calculation, it is not part of the output, production, etc. It is part of the personal income. This is first thing. Second important aspect is there are certain things which are part of the national income. There are some things which are part of the national income, but they do not become part of the personal income. For example, if you try to understand. So when I say Viper, what is this P? Profit. This is profit. Now if I have to further divide the profit, profit can be divided into something like dividends. Dividends are going to the shareholders, okay, or it can also be divided into something like undistributed profits. I'll write it as undistributed profits or retained earnings. Profits or retained earnings. Okay, the meaning of retained earning or undistributed profit means this factory is keeping the profits with itself and it is not distributing in the form of wage, nor interest, nor profit, nor rent. So this is something that is retained by the factory, maybe for future. So this profit which is retained by the factory, which is called as the undistributed profit. Undistributed, this profit is not getting distributed to the household, or it is called as the retained earning, which is retained by the factory, which is not getting distributed to the household. That means this undistributed profit is, though it is part of the national income, it is not going to become part of the household or household's personal income. Are you able to get this point now? Why? Because this is something which is retained here only, which is not getting distributed to the household, and therefore it is not part of the personal income. I think you're able to get this. So if I have to talk about profit, profit can be divided into dividends, profit can be divided into undistributed profit or retained earnings of the company, or it can also be, profit can also be something like, the third component of profit is the corporate tax. So basically when we solve numerical problems, he will not give profit. He will give corporate tax, dividends and retained earnings. When I add all the three, you arrive at what? Profits. You arrive at, you calculate, you add up retained earnings with dividends, then to add to it to corporate tax, you arrive at profit. Now even this corporate tax, from the profit, the company is going to pay what? Corporate tax. From the profit, the company is paying corporate tax. That means this corporate tax is going to whom? Government. That means this corporate tax is also not getting distributed in the form of factor payments to the households. Are you able to get this? So this portion of profit is not getting distributed in the form of factor payment to the household. So that means this aspect of undistributed profit or retained earnings, this undistributed profit or retained earnings, or this aspect of corporate tax, these are part of national income, that is, they are part of profit, okay, but they are not going to be part of household income or the personal income because they are not getting distributed. So is this clear? So clear, no? Transfer payment is not part of the national income, but transfer payment is part of the personal income. Okay, but retained earnings and corporate taxes, they are part of the profit. That means they are part of the national income, but they are not part of the personal income because they are not getting distributed. I hope it is clear till there. Okay, and then there can be something like aspects like net interest paid. Net interest paid. This will also not be part of the personal income. Why? Because suppose the company has taken some loan from outside. Okay, so from a bank, etc. So from its profit, the company is going to pay the interest and all to the bank. So this interest which is moving out is also not going into the hands of the household. So therefore, this will also not be part of the personal income. So if you have understood this, that means if I have national income in hand, that means you know about national income. From national income, I have to subtract, deduct undistributed profits, okay, or what? Retained earnings, okay. Then I have to also subtract corporate tax, because this is also going to the government, it is not going to the hands of the household. I also have to subtract the net interest. Then something that is not part of the national income, that becomes part of the personal income, has to be added. What is that? That is nothing but the transfer payments. I hope it is clear till here. Okay, and when I add transfer payment now, then I arrive at something called as the personal income. That means this personal income includes both productive income and also transfer payments. So government's transfer payments or receipts, scholarships or pensions are all going to be part of my personal income. Now from this personal income which I have, okay, I have to pay my direct taxes, like my income taxes. Yes or no? I have to pay my taxes, and I also have to pay some fines and fees, whatever it is. Okay, and then whatever is remaining, which is going to remain, is called as the personal disposable income. Personal disposable income. This personal disposable, that means the income at my disposal, the income which I have at my disposal for consumption or for saving. Either I can consume, go buy something, or I can save. So this personal disposable income will decide the demand in the economy, isn't it? So this personal disposable income will decide the demand in the economy. Is this clear, everybody? So this personal disposable income can, again, this was something leading to what? Consumption, or I will save. I hope it is clear. From here, it can turn out to become investments, etc. Now, this is how from national income we arrive at personal income. For that, the concept should be clear. So, first thing is, when I use the word profit, profit includes these three. And there are some things which are not, though which are part of national income, but they are not part of the personal income. I hope it is clear. Okay, so where is the watch? No, wait. Actually, there is no watch. Actually, he is looking into the watch there. This is extraordinary. Watch is not there. Actually, his friends are also actually there. They don't have a watch, I think. This guy is looking reverse. You can ask me, I'll tell you. Okay, so I'll give you a break. You'll forget again. I have to explain again. I will not give like that. You first write on left hand side, write personal income, and on right hand side, put national income. Two side headings. Personal income. So first point in the personal income, write down. It includes both factor incomes. It includes both factor incomes and transfer receipts. It includes both factor incomes and transfer receipts. That I think it is clear. Okay. On the right hand side, under national income, write down. Under national income, write down. Transfer payments are not included. Transfer payments are not included in the national income. Is that okay? Next, under personal income, write down the second point. Undistributed profits of companies. Undistributed profits of companies and corporate taxes are not part of personal income. Are not part of personal income. Okay. Right hand side, write down under national income. Undistributed profits of companies. Undistributed profits of companies and corporate taxes are included in national income. Are included in national income. Is that okay? Next point. Write this point. This is under personal income. Write down under personal income. Interest on national debt. Interest on national debt is included in personal income. Is included in personal income. On the right hand side, write interest on national debt. Interest on national debt is not part of national income. Is not part of national income. Okay. Now see this question, till now they have not asked in UPSC prelims, they have asked in CAPF. Okay. So they have asked which of the following is part of national income, and they have given one option, interest on national debt. So interest on national debt is, generally interest should be included, generally. Is interest part of national income? Calculation. Why are you thinking so much? I'll ask you this question. Suppose the interest paid by the bank to its depositors, interest paid by the banks to its depositors, is it part of national income? Yes, because through those deposits, bank is rendering some output or services. Are you able to get this? No? That means indirectly bank is taking loan from you, and with that bank is rendering some output. Yes or no? And therefore that interest which the bank is paying to you is part of calculation. Are you able to get this? Okay. But national debt interest is not that. National debt interest is, suppose government is raising debt, public debt, government is raising debt, but this debt which the government is raising is not for producing any goods nor services. This debt is raised maybe for bridging deficits, handling deficits, or maybe government wants to use that money later. Government is not using it right away. So such kind of public debt, or the interest which, suppose government decided to issue some bonds or whatever it is, and government decided to raise some money, loan, but that money government is not using for any productive purpose. Not using for any productive purpose means for production or rendering goods nor services. And therefore, this interest which you receive on this national debt, this interest which you receive on national debt is seen as a kind of a transfer payment. Now, this money is seen as a transfer payment, and therefore that is not getting included in the national income calculation. So this is an exception. So generally interest is included. So Viper, wage plus interest plus profit plus rent. That means interest is there. So interest is getting included in the calculation. No issue there. It is a factor income. Is that okay? But national debt interest, where the government is not using that loan, it has raised the loan, debt, use the loan for any productive purpose. Since it has not used it for productive purpose, this interest which it is giving will not be seen as your income. It is not be seen as your income which is coming in. So it will be taken as a kind of a transfer payment, and that is the reason interest on national debt is part of your personal income but not part of national income. Is that okay? Not okay. Is this clear? Okay, so take a break. Okay. So put the heading personal income. Why is interest on national debt not included in national income? It is basically treated as a kind of a transfer income. Okay, why? Because no specific good nor service is produced from that debt. It is taking this loan. Generally, if we go deeper and deeper, then it will become more complicated, not required for UPSC. So that's the reason. But this is clear, no? No? Yes. No, koi bole. Okay, so actually when loans on consumption expenditure, consumption for loans for consumption purpose, loans which are given, interest on loans for consumption purpose, consumption, you are buying and doing, eating something, that interest will not be part of the national income calculation. So that will not go there, but bank, if the depositors are putting money in the bank, there is some interest that is coming. With this depositors' money, this is something like bank is taking loan and giving some, and it does some productive activity. No, it is doing some productive service there. Okay, there it is a kind of loan taken to produce something. Bank is producing or rendering a service. Okay, so from that money, and therefore that interest will be part of national income calculation. Its bank is a kind of a firm basically. Okay, and firms produce output, production. Now this firm is producing a service or rendering a output. Here the output is what? Service. It is rendering service, and therefore that loan taken by bank for rendering this banking service, the interest which you receive will be part of national income. Is this clear? Okay. But suppose government is taking loan, but government is using it for consumption. Suppose government has taken this loan to give subsidies or to give scholarships, whatever it is. Government is not doing any productive activity here, not doing any productive activity. Government is not producing anything. Government is not producing goods nor rendering any service. That is the reason that interest on national debt is seen as a transfer payment, and it is part of the personal income and not part of the national income. Is that clear? Yes. So personal income, it is the income of the households. It is the income of the households, including factor incomes, including factor incomes and transfer payments, including factor incomes and transfer payments. Then put the heading personal disposable income. Personal disposable income, write down. Income that remains with the individuals. Income that remains with the individuals slash households slash households after the deduction of direct taxes, after the deduction of direct taxes, after the deduction of direct taxes levied on their income and property, levied on their income and property. Okay, so write the formula. Personal disposable income is equal to personal disposable income is equal to personal income minus direct taxes minus miscellaneous fees and fines, minus miscellaneous fees and fines, miscellaneous fees and fines paid by the household. Is that okay? Next, put the heading per capita income. Per capita income. What is this per capita income? Total income by total population. This is what we say, per capita income is total national income by total population. Okay. Now, when we talk about per capita incomes, we are taking the averages, isn't it? We are talking about mean. So, in the statistics, mean, median, mode. Heard of it? Okay. So, here we are talking about average income. Average means you are talking about mean income. Is that clear? Okay. So, total national income by total population. So, if I have to calculate current per capita incomes basically, then I have to take something like NNP at current prices. NNP at current prices divided by population. Write down first, I'll explain. Per capita income, write down. Per capita income. It indicates the average income. It indicates the average income. Average income per person earned in a given area at a particular period of time. For a nation, nominal per capita income. Nominal per capita income. Nominal is at current price. Okay. Nominal per capita income is NNP at current prices. NNP at current prices. NNP at current prices divided by total population. Divided by total population. Real per capita income is then computed. Real per capita income is then computed. By adjusting inflation with nominal per capita income. By adjusting inflation with nominal per capita income. Continue. Internationally, per capita income is compared between countries. Per capita income is compared between countries based on purchasing power parity. Based on purchasing power parity. Based on, you write it, then I will explain. Based on purchasing power parity, continue. The PPP method compares, the PPP method compares economic productivity and the standard of living between countries, It compares different countries' currencies. Through a basket of goods approach, where the prices of goods are compared, Okay, now see, one is we have understood what is per capita income. So generally per capita income is something like the national income divided by the what? Total population. So if I have to calculate current prices, per capita income, so at current prices, so what it is NNP at current prices divided by the total population. From here you adjust it to base year prices and then you arrive at something called as the real per capita income. But if I have to make a comparison between different countries, you compare it using a concept called as PPP or purchasing power parity. Let's try to understand this word, purchasing power parity. Now see here, when we talk about exchange rate, it is a rate at which one currency is exchanged with the other. So we will discuss this again in detail in our external sector class, but we'll try to understand few things here as far as PPP is concerned. So in the forex market, what happens in a forex market? Market is a place where buyers and sellers meet. Forex market is a place where buyers and sellers meet to buy and sell currencies, basically. Okay. So in the forex market, what is that will decide the value of currency? It is the market. That is the reason you are calling it as forex market. You are saying market means it is the forces of demand and supply. For example, if I say $1 is equal to 60 rupees or $1 is equal to 70 rupees, this value of conversion of one currency into another is based on demand and supply. Okay. So we have drawn a basic demand graph and a basic supply graph earlier. Yes. So here let's put on the x-axis, let's put quantity demanded as well as supplied. Okay. And here I am putting price of rupees in dollars, or I'll put it reverse, price of dollars in rupees. Okay, so I'll put it that way. So I'll put price of dollars. This is quantity demanded of dollars. Here I am putting price of dollars in rupees. Price of dollars in rupees. So I'm taking quantity demanded of dollars or supplied of dollars and price. So here, how does a basic demand graph look like? This is the basic demand graph, rightward sloping. Is that okay? Okay, so then basic supply graph. This is how a basic supply graph looks like. This is a basic supply graph. So the intersection point is how the price is decided. Let's say price is $1 is equal to 60 rupees. Now there is too much of demand. Demand increased in the market. Okay, so in the market there is more demand for products. Demand for dollars in the market. So if there is more demand for dollars in the market, okay, more demand for dollars in the market, what will happen to the demand graph? More demand means rightward shift or leftward shift? Right, we have discussed that. More demand for dollars means there will be a rightward shift with respect to the demand graph. So this is the new demand for dollars. That is what happens. So there is increased demand, so there is a rightward shift with respect to the demand graph. So now this is the what? New equilibrium point. So that means now the new price of dollar turns out to become something like 70 or 72. So how $1 became 72 now? It is because of the forces of demand and supply. Forces of demand and supply, earlier it is 60, now we are putting it as 72. It is because of increased demand for dollars. Now this is basically nothing but the nominal exchange rates. Nominal exchange rate. Daily whatever we see in the newspaper, that today $1 is 70, 71, 69, 73, 74, whatever you see, all this $1 is equal to rupee conversion is basically what exchange rate? It is nothing but the nominal exchange rate, which is based on the factors of demand and supply. Whatever is the rate in the forex market based on the market fundamentals, that is what is the nominal exchange rate. It is the exchange rate at which we are able to convert dollar into rupees or rupees into dollar based on the fundamentals of market economy, that is demand and supply. Okay. Now this nominal exchange rate keeps on changing every day. Okay. Now the question here is it that, suppose I ask you, is it always better to go to a developed nation if you want to become rich? Just a normal question. So do you, no, it is better to be in India to become rich. So, okay, very good idea. Suppose you are a worker, you are a software employee, I'm just asking you. Okay, so he will become rich by doing some business, etc. That's a different thing. But if you are a software employee, is it better to work for Infosys in India or is it better to work for a multinational company in US? The answer is definitely it is better to work for MNC in US. There is no second thought about it. Why? Because for a simple logic, here generally when we talk about the software jobs and the salaries, definitely you get a higher pay there. Okay, but it is not that you will become 70 times richer faster in US. $1 is 70, so you will become 70. No. It all depends on an aspect called as purchasing power parity. Purchasing power parity because inflation is also there. Okay, it's not that, see, $1, it is all about, let's say, if a basket of goods which I'm taking a basket of necessities. Now this basket of necessities I'm able to buy for $1 in US, and the same basket of necessities I'm able to buy it at, let's say, 35 rupees, same basket I'm able to buy at 35 rupees in India. I'm taking a basket of necessities and this basket is costing $1 in US, and the same basket I'm comparing it in India, basket of goods, it is costing 35 rupees. So therefore, the purchasing power parity exchange rate in this case is what? $1 is equal to 35 rupees. $1 is equal to, that means a basket of goods which I'm able to buy in a country like US for $1, the similar basket when I'm able to buy for 35 rupees in India. So this PPP exchange rate, this indicates the purchasing power of dollar and rupees, purchasing power of dollars and rupees. Is this clear? So let's try to understand it with an example now. Now observe very clearly. So for example, let's try to understand it like, for example, let's say there is this country called US and India, and in this case ice creams are available. This basket of goods has only one item now. This basket of goods has only one item, that is ice cream, and this ice cream is costing $1 in US, and the same basket of ice cream is costing how much? 35 rupees in India. Now, nominal exchange rate is $1 is equal to 70 rupees. Nominal exchange rate in the market is how much? $1 is equal to 70. Now, in this case, in this example, will US buy ice creams from India, or will India buy ice creams from US? In this case, US will buy ice creams from India, because with $1 you will get 2 ice creams from India, but with the same dollar you will only get 1 ice cream from India, and therefore this situation will encourage exports for India. This situation will encourage exports for India. Is that okay? Now, for suppose this ice cream is costing same only, $1 here and 35 rupees, but nominal exchange rate has become 140. That means rupee value has depreciated. Now nominal exchange rate has become 140. Okay, $1 was 70. Now the exchange rate, nominal exchange rate became 140. In this example now, if it becomes 140, it will boost India's ice cream exports, or it will reduce India's ice cream exports? It will boost India's ice cream exports. That means India will become more competitive with respect to ice cream exports, because now with $1, US will be able to get 4 ice creams from India. $1, because $1 is now how much? 140. 140, and each ice cream is 35. So with $1, US will be able to get 4 ice creams from India. That means in this case, India's exports will become more competitive. India's exports will become more competitive. There will be more exports from India. Is that okay, everybody? Now, is this clear? Now, suppose, I'll take another case here. Another case is, let's say, nominal exchange rate became $1 is equal to 35. Nominal exchange rate. 2 cases. First case, $1.70. Second case, $1 is equal to 140. Third case, $1 is 35. So, when $1 is equal to 35, what will happen to trade? Will US buy ice creams from India? No. $1, you are getting 1 ice cream. And with 35 rupees, if you buy from India also, ice cream is 35 rupees. So, you are going to get 1 ice cream only. That means when your nominal exchange rate that is equal to PPP exchange rate, nominal exchange rate, that $1 is 35 is what? PPP basically. That is, the cost of the basket of goods in India is 35 and the cost of the basket that ice cream is $1. So when both are 35 means nominal exchange rate is 35 and also the ice cream cost is also 35 here and it is $1. So therefore there is no point in trade. So there will $1, in this case there will be no trade between India and US. There will be no trade between India and US. I hope it is clear. Is that okay? Clear? No. Now suppose another case. Now this is the first case, $1 is 70. This is the second case. Okay. Then I said nominal exchange rate is $1 is equal to 35. Now for suppose $1 becomes 17.5 rupees. $1 becomes 17.5 rupees, nominal exchange rate. This is, ice cream is costing 35 in India. Ice cream is costing $1 in US. Okay. So now $1 is 17.5 rupees. Then what will happen? India is going to buy ice creams from US. Now this is not going to be reverse now. Ice cream here is 35 rupees and $1 is 75. So that means with 35 rupees, you will be able to get more. So that means in this case, is that clear? In this case, US is going to export ice creams. US is going to export ice creams to India. Is this clear? Okay. Now suppose I have to talk about trade competitiveness of India. So I want to measure how competitive India's trade is. Okay. Now when I talk about PPP here, so this ice cream is this ice cream is a basket. I said this basket of good. Instead of taking a basket of good, I've only put one item in the basket, and that one item is ice cream. Now, instead of ice cream, if I take a basket of goods, let's say, this basket of goods in US is costing $1, and the same basket of goods in India, is costing 40 rupees. It means, what is the PPP exchange rate in this case? PPP exchange rate is $1 is equal to 40 rupees. PPP exchange rate is $1 is equal to 40. So that means this PPP exchange rate is something like 40 rupees per $1. This is the PPP exchange rate. Is that okay? You're able to follow? Okay, so PPP exchange rate is 40 rupees per dollar because $1 is 40. The same example here, this 40 is not a little confusing. I'm only taking the ice cream. So in this case, ice cream case, PPP exchange rate is how much? $1 is equal to 35. PPP exchange rate is $1 is equal to 35. That means PPP exchange rate is 35 rupees per dollar. PPP exchange rate is 35 rupees per dollar. What is this 35 rupees per dollar? It indicates like the domestic price. What is the domestic price of ice cream? 35 rupees divided by the foreign price. Divided by the foreign price or the US price. Domestic price is how much? 35 rupees. Foreign price is how much? $1. Is this clear? So that means PPP exchange rate is nothing but the domestic price divided by the foreign price. I hope it is clear. Is this clear till here, everybody? PPP exchange rate is domestic price divided by the foreign price. So now, when I have to talk about trade competitiveness, now the question comes up, I am talking about trade competitiveness of India. So I'm interested in estimating how competitive India is. Trade competitiveness of India. Now this trade competitiveness of India, is it directly proportional to, in this case, in this example, is it directly proportional to NIR or inversely proportional? India's trade competitiveness means India's trade competitiveness increases if India's exports increase. India's trade competitive means what? India is exporting more. Take it like that. India's trade competitive means India's products are taken by others. Okay. So, India's now trade competitiveness of India, is it directly proportional? Is it directly proportional to nominal exchange rate or is it inversely proportional? Directly proportional. Why? Because when $1 is 70, they were buying 2 ice creams. But when $1 became 140, that means nominal exchange rate increased. $1 became 140. That is direct, it is increased. No, nominal exchange rate increased, then there will be more exports from India. There will be more exports from India, means India is becoming more trade competitive when the nominal exchange rate is increasing. So that means trade competitiveness is directly proportional to the nominal exchange rate. Is this okay? Yes. Now next question is, what about the price of ice cream in US? Okay, no. Trade competitiveness, is it directly proportional to the price of ice cream in US or is it inversely proportional to price of ice cream in US? Simple logic here, listen, if the ice cream in US becomes $2 instead of $1, everything else is same, $1 is 70, okay, ice cream cost in India is 35, ice cream cost in US now, instead of 1, ice cream cost in US became $2. You're able to get this? Okay, so now what will happen to the exports from India? Will it increase or will it decrease? Okay, I'll repeat the question. Think and answer. अरे यार सुनो. You are like, let the question go to your head, no? You are answering straight away. $1 is 70. Okay. Ice cream is 35. Earlier case, ice cream is $1. Okay. So with this $1, that is $1.70, no? So with $1, US was able to get 2 ice creams. Okay, 2 ice creams. Now, if US has to buy ice creams in US, if US wants to buy the same ice cream in US, now it has to pay $2. It has to pay $2. Everything else is same. $1 is how much? 70 rupees. In India, what is the cost of ice cream? 35 rupees. 35 rupees. Now, in this case, US will buy more ice creams from India or less ice creams from India? More ice creams from India. Now, because if you are putting $1, you are getting 2 ice creams from India. Here, if you put $2 also, you will get only 1 ice cream. So, US, with this $2, US will be able to get 4 ice creams from India. Yes or no? You're able to catch it? So, with $2, US will be able to get 4 ice creams from India. So, that means if the price in US or the abroad price or the foreign price or US price, if it is increasing, it is beneficial for India's trade or not beneficial for India's trade? Beneficial for India's trade. Is that okay? So, trade competitiveness is directly proportional to the foreign price. Can I say this? Is this okay? Trade competitiveness is directly proportional to foreign. Directly proportional means what? If the ice cream is increasing from $1 to $2, there will be more exports from India. There will be more exports from India. That is what I mean by trade competitiveness is directly proportional to foreign price. You are thinking too much, no? That's why. Very good. Is that clear? Now next. Then what about price in India? What about trade competitiveness impact on price of ice cream in India? Let's take this like this. Now, ice cream cost in India, instead of 35 rupees, if it becomes 70, ice cream cost in India, instead of 35, it becomes 70. Will it increase trade competitiveness of India? No, it will not increase. It will reduce the trade competitiveness because US will not buy ice cream now. $1 is 70. You will get 1 ice cream only from India. $1 is 70 and ice cream is also 70. Means you will get 1 ice cream from India. So better with that $1 you buy ice cream in US only. Yes or no? That means the trade competitiveness of India is inversely proportional. Obviously, the price increases, you will become less trade competitive. No, your price is increasing. So, trade competitiveness of India is going to be inversely proportional to the, not foreign, this is what, Indian price. Indian price. It is inversely proportional to the Indian price. Till here, is it clear? Okay. So, based on this, that means if trade competitiveness has to be calculated, India's trade competitiveness is directly proportional to NER, nominal exchange rate. Okay. It is directly proportional to foreign price. Okay. And it is inversely proportional to domestic price or Indian price. Is that okay? We are not talking about anything like effective exchange rate here. We are only talking about real exchange rate. First we have discussed nominal exchange rate, demand and supply, and then we have used PPP exchange rate. What is PPP exchange rate? Domestic price to foreign price. Is that okay? Domestic price to foreign price. So here I can write this trade competitiveness as, I can write the same equation as NER divided by domestic price of ice cream in India by foreign price of ice cream. Can I write that way? Domestic price divided by foreign price. I've put this down, that's all. Okay, so that means this will become nominal exchange rate divided by, this is what? This is not per capita, this is nothing but purchasing power, PPP exchange rate. PPP exchange rate is nothing but what? PPP exchange rate is domestic price divided by $1 is 35 rupees per dollar. So trade competitiveness is equal to nominal exchange rate divided by PPP exchange rate. Have you understood this? Is that okay? Anywhere any problem, I'll explain again. That's the reason I'm asking. Have you understood? Have you understood? So understood, that means, okay? So nominal exchange rate divided by PPP, because PPP is nothing but domestic price divided by the foreign price. Now this is also called as, this nominal exchange rate divided by PPP is also called as what? The real exchange rate. Real exchange rate. So trade competitiveness is measured using this aspect called as real exchange rate. Trade competitiveness is measured using real exchange rate. Now whenever we are comparing with other countries, even with respect to poverty, for example, World Bank says if you are getting less than $1.9 a day, you are a poor man. It is seen as extremely poor. World Bank defines poverty. If you get less than, if somebody is getting less than $1.9 a day, okay, then you are treated as extremely poor. Now this $1.9 is, this dollar is not $1 is equal to 70. This $1 is not the nominal exchange rate. It's not 1.9 into 70 rupees in India. When you are making a comparison, we take a basket of goods and then make a comparison. That means poverty is defined as at PPP exchange rates. PPP exchange rate, what $1.9 can buy in US, the similar basket is going to be purchased for how many rupees in India. Since he is not able to afford that basket also, then you are calling him a poor man. I think you're getting my point. So it is about what? This $1.9, this is what exchange rate? You have to make a comparison for poverty also, it is at PPP exchange rate. Is this clear, everybody? Now when you are saying per capita income is so many dollars in US, and you're saying per capita income is so many rupees in India, okay, or so many dollars in India. Now how do you make a comparison between US and India? You are not going to make comparison between countries based on the nominal exchange rate. You are going to make comparisons based on PPP exchange rate. PPP exchange rate. What $1 can buy in US, the similar basket you are able to get it for how many rupees in India. This is how I measure what is called as purchasing power parity exchange rate. So for measuring or comparing poverty or for comparing something like the per capita income, because of what that income can buy for you is what is important. So that income can buy, what that income can buy in US, and similarly you are making a comparison with India. Is this clear? Okay. So, and remember, trade competitiveness is basically decided by, trade competitiveness of a country is decided by which exchange rate? Real exchange rate. And to remind you, we have not discussed nominal effective exchange rate or real effective exchange rate. This we have not discussed. This I have discussed in the exchange rate class. This we have not discussed. That is a different concept. Okay, here we have only touched nominal exchange rate and real exchange rate. Now I'll ask you one more question. In this example, now we have arrived at real exchange rate. Suppose if this real exchange rate is equal to 1. What is the meaning of real exchange rate equal to 1? Nominal exchange rate is equal to PPP exchange rate. Okay, that means in this, go back to the example. That means this is $1 became 35. Nominal exchange rate became 35. Okay, and ice cream is also 35. Yes or no? Are you able to get this? No. $1 nominal exchange rate is 35. Ice cream is also 35 rupees. Then what will happen? Then in that example, that means this nominal exchange rate is 35. PPP exchange rate is also 35. In that case, will US buy ice creams from India? No. That means when real exchange rate is equal to 1, what will happen is you will not have trade. There is no trade. Real exchange rate became equal to 1. There is no trade. Why? That example of ice cream, 35 rupees ice cream and $1 is also 35. So there is no point in buying from India. With that $1, they'll buy ice cream in US only. So there's no question of import and export in this case. No import, no export. No trade only. Is that okay? Now suppose, if we take it this way, suppose if real exchange rate is greater than 1. Real exchange rate is greater than 1. Greater than 1 is what? That example of near is 70 rupees, no? Nominal exchange rate was how much? 70. And ice cream PPP exchange rate was how much? 35. So this becomes 2. Rear became 2. That means rear is greater than 1. If rear is greater than 1, real exchange rate is greater than 1, then what will happen in this case? India will be able to export to US. Yes or no? India will be able to export to US. That means here India will export to US. India will India will export. So in this case, India will export to US. That means it indicates that we can export more. Okay. Then the same example, 17.51, rear became less than 1. That means this is less and this is more. Let's say reverse these numbers. Reverse these numbers. Suppose if nominal exchange rate is 35 and PPP exchange rate is 70, then it becomes 0.5. Okay. In this case, what will happen? US will export to, or India will buy from US. India will import. India will import. India will import from US. Is that okay? Is the concept clear? So, what was the last thing you've written? We have written it compares different countries' currencies through a basket of goods approach where the prices of goods are compared. Now, if you read that once, read it, you will understand PPP exchange rate. I hope it is clear. So, you're taking a basket of goods and comparing it with in one country, the same basket you're checking it in other country. Then you're deciding what is the PPP exchange rate. Okay. Then put the heading nominal exchange rate. It is the value of foreign currency expressed in terms of domestic currency. For example, the value of $1 expressed in terms of Indian rupee is rupees 70. Continue. NER means NER means how many rupees somebody will get when he sells $1, when he sells $1, when he sells $1 in the exchange market, when he sells $1 in the exchange market, that is near depends on market forces of demand and supply. Market forces of demand and supply. Is that okay? Then put the heading PPP exchange rate. Write down. Let us consider an example. Let us consider an example where an ice cream is costing 35 rupees in India, where an ice cream is costing 35 rupees in India, and the same ice cream can be purchased at $1 in US. $1 in US. Continue. The PPP exchange rate in the above case, is arrived at by comparing prices of ice creams in both the countries. That is $1 is equal to rupees 35. $1 is equal to rupees 35 is the PPP exchange rate. It can also be written as rupees 35 per dollar. It can also be written as rupees 35 per dollar divided by dollar, no? Rupees 35 per dollar, which implies whatever rupees 35 can purchase in India, the same item can be purchased in US. The same item can be purchased in the US for $1. It means purchasing power of rupees 35 in India is equal to purchasing power of rupees 35 in India is equal to purchasing power of $1 in US is equal to purchasing power of $1 in US. Is that okay? PPP exchange rate is equal to domestic price by foreign price. PPP exchange rate is equal to domestic price by foreign price. Continue, next point. Trade competitiveness of a country is decided by real exchange rates. trade competitiveness of a country is decided by real exchange rates. That is, trade competitiveness is directly proportional to directly proportional to nominal exchange rate nominal exchange rates comma directly proportional to foreign price or US price and inversely proportional to the domestic price of the product. Inversely proportional to domestic price of the product. Is that okay? Then write down, therefore, trade competitiveness is equal to price of ice cream in US that is foreign price. Price of ice cream in US multiplied by nominal exchange rate divided by price of ice cream in India. That is what price? Domestic price. Is that okay? So then below that write down that is equal to nominal exchange rate divided by domestic price by foreign price. Okay. So that is equal to write down nominal exchange rate divided by PPP. Why? Because PPP is nothing but domestic price to foreign price. That is equal to nominal exchange rate by PPP. Is that okay? Yes. This is equal to real exchange rate. That is equal to, right, real exchange rate. Okay, that's all. Yes.